Hi, everyone, and welcome back to the Nick Hilaire Show. The interest rate story, part of that story always made sense to me because I've been operating in real estate. And so I've felt exactly that phenomenon you describe, which is that when you can borrow for nothing, like it makes the deals way easier to pencil and underwrite. It's just basic mathematics. When the borrowing cost is low, it's easier to make sense of these deals. And so it did create this chase for yield. But I never really understood how the QE funds themselves were getting into the financial system. So just so I'll make sure I understand it. So it sounds like when that transaction happens, the basic QE transaction, which is the purchase of bonds from the government, from a bank by the Fed, they basically give the bank a credit with which to do something. And the banks were able to either do loans with those funds or purchase additional securities. Were the banks able to invest directly in equities with that money?
Well, there's bank regulations that limit what banks can do. So it depends on the bank, and generally they don't really. But the banking system is the conduit. That you have to think of the banking system as a pipeline. That's where the liquidity goes through, and then it gets shuffled from bank to bank, and it gets shuffled to brokerages and to individuals. So once it's through the banking system, it spreads out, and um, so just very basically, every bank in the United States has a sort of checking account with the Federal Reserve. Federal Reserve is like their bank, and it's called the reserve account. And so that's how, when a bank pays another bank, they pay each other through their reserve accounts. And the reserve accounts are incredibly active. I mean, there's trillions of dollars flowing through every day. And when you pay your mortgage to your mortgage lender, so that money comes out of your bank, and it gets sent to the mortgage holder at another bank, and they all flow through the reserve accounts at the bank. So at the Federal Reserve, so one bank through another bank, and they pay each other once a day. Every bank pays every bank once a day. And
Yep.
that's it's trillions of dollars, and all transactions flow through there. And it's in these checking accounts that the Fed would put these credits, so that $10 billion credit for those bonds goes into that reserve account, say at JP Morgan, and then JP Morgan delivers the bonds to the Fed, and JP Morgan has $10 billion to do something with, and then it does something with it, buys more securities, and then somebody else has this $10 billion, and they're buying something else with it. So it starts picking up momentum, and the $10 billion starts circling around because everybody's buying stuff with it, and there has to be a seller on the other side. So if I buy something, somebody has to sell it to me. The seller gets the money, and then the seller buys something else with it. And it may be not a security; it may be real estate, and then the seller of the real estate buys something else with it. And so it created this kind of tornado of money going through the economy. And it's not the initial act of printing money that causes this. It's once the money goes out there and starts chasing and flowing around, and it doesn't go away. It just keeps getting handed around. Every buyer gives this money to the seller, and the seller does something with it, and it goes from there. And it so it's not that one act of giving $10 billion to JP Morgan for $10 billion in bonds. It's what happens afterwards when that $10 billion enters the financial world and starts swirling around.
Yeah, that's really helpful, and it makes total sense. It's like if you go into that moment in history with a stratified society, the problem, like it sounds like the fundamental problem with QE is that it is an intervention that essentially is by design only possibly able to help people who have assets, because it's not like the banks are going to like give a bunch of consumer loans with that money. Like they're going to play, try to earn money by dealing with Blackstone or this, with that extra funds with that extra credit that they have in the reserve account. They're way more likely to do business with someone with assets than they are to help a sort of ordinary American consumer. So it makes sense to me from that perspective.
Well, it was actually, you're right, it was actually formalized that way by Fed Chair Ben Bernanke in 2011. He wrote an editorial in the Washington Post, which I keep on my computer, on my hard drive, in case the Washington Post ever takes it down. And he explained that system to the American people back then, and it's a doctrine that the Fed calls wealth effect, and it's well established. It goes back a decade or more before the financial crisis. There are all kinds of papers on it, and Janet Yellen, when she was president of the San Francisco Fed, she wrote about it. It's a paper of her discussing the wealth effect. And the wealth effect, the doctrine says that the central bank can make the asset holders wealthier. They can create wealth through money printing and interest rate repression. And so the wealthy people that have these assets become wealthier, and then they spend some of this money. And as they spend this money, it props up the overall economy because it's part of consumer spending. So maybe they're buying a new house, or they're building something, building a castle, or buying a yacht and a new vehicle, and they're splurging on other stuff. And hopefully the yacht is made in the United States somewhere, and so there'll be jobs and people make money. And so this is the whole theory of the wealth effect. And Ben Bernanke explained that to the stunned American public, that the Federal Reserve is purposefully making the wealthy even wealthier so that they feel wealthy and feel rich and spend a little bit more of their money and hopefully prop up the economy. And the wealth effect has so this is an official doctrine, and there's all kinds of economists that have written about it. So you can Google that. And it has a very spotty record in terms of helping the actual economy. It has a very solid record in terms of making the wealthy wealthier, but the trickle-down effect of that wealth effect is pretty small. And you end up with this huge division in wealth. And so, yeah, that's the principle that the Fed did this on, is the wealth effect. And personally, I think the wealth effect has been discredited. I think it's bogus. It's a fake doctrine, and but that governed the Fed's action at the time, and it was well established in economic literature, and Bernanke explained it to the American people, and so it's not something the Fed did secretly. It discussed it. It said, this is what we're doing, and this is why we're doing it. We're going to make the wealthy wealthy, and hopefully they spend a little bit of that, and it's going to help the economy. And that was the theory. I think the current Federal Reserve thinking is different. I have not heard anything about the wealth effect. Some of those wealth effect papers have been taken down, and I can't find them anymore. I still have the links, but they don't work anymore. And especially a couple of those at the San Francisco Fed, they're gone. And so, yeah, nobody has mentioned that for the last few years. So I think that theory is no longer the case. We now have quantitative tightening, the opposite. It looks like they're going to keep doing it for a while. Interest rates are reasonably high at 5.5% at the upper end. So this is a different scenario now, but we're talking about the past here.
Yeah. Wow.